or backtesting the ideas shown here. Stochastic was invented by George Lane for more than 50 years ago. It is needless to say that the reason for it still being around is the popularity of this tool. Stochastic is a momentum indicator which tells us how strong or weak the current close is compared to the previous high-low over a set number of bars. So if the close is consistently at the high range, we are seeing a rising stochastic, we are then experiencing buying. If we're seeing consistent closes at the low range, we're seeing a falling stochastic, which means we are experiencing selling. The default settings for stochastic is 14, 3, 3. Let me just quickly tell you what this means so you know what you're trading. 14 means that stochastic is calculated by using the last 14 bars. 3 symbol is a 3 symbol moving average used to smoothen out the stochastic so you avoid noise and fake signals. And this 3 symbol moving average is a trigger line. So stochastic line, also called the %K, is the white one here. And the trigger line, also called %D, is a purple line. The signal occurs when we have a crossover. Of course, the setting is entirely up to the trader. Traders looking for scalp might use a 733 setting instead. Like with all indicators, the lower the settings, the more whipsaws. So you have to backtest and forward test to see which setting suits you best. When stochastic is below the trigger line, the momentum is to the downside, and when stochastic is above the trigger line, the momentum is to the upside, however brief this momentum will be. Many traders believe that the overbought and the oversold levels are the main use of stochastic. So if stochastic is above 80, many traders will look to go short, and when stochastic is below 20, many traders will look to go long. This was not George Lane's idea with the stochastic, because stochastic can stay overbought for a long period of time. You see this here. However, he did believe that the best signals came after hitting these extremes, so he would be looking for this crossover here, and here, and here, and avoid these crossovers. I will show some trade examples, and then I will also show you how to avoid going short during these times here where stochastic can stay overbought for a long period of time, resulting in many losses. Okay, here's the same chart again, but I want to start fresh so I can emphasize how important it is for you to analyze the stock you're about to trade instead of only focusing on the entries. And if we do analyze this stock, we'll be able to avoid going short here and here, just like I promised you I would show you. So first, if you look at your MA, you see that it's upsloping. So if you have a rule in saying you're only allowed to go long when the MA is upsloping, you would avoid going short here and here, but you would catch these winners down here. Yes, you would miss out on these winners, but that's okay, because it's not the quantity of trades, it's the quality of trades we're focusing on. So now I'll show you how I would approach this when I were to enter it. First, look at your MA, it's upsloping, so the trend is up. That means I will only take oversold levels. So we'll go and locate those. We got an oversold here, and one here, and a third one here. And third, I'll be looking for crossover, the stochastic crossing up through the trigger line happening here, and here, and here. Because no indicator is perfect, you have to place your stops accordingly to the chart. So if I enter the trade here, I'll be looking to place my stop underneath last swing pivot low. When my entry is here, I would place it underneath last swing pivot low, here. And here, it has an equal low with this one over here. So I would place my stop underneath this low over here. Here's another setup using stochastic, but I've added divergence to the trade. But before showing you the entry, I want to do the analysis. First, I see that the MA is moving down, but suddenly it stalls and moves sideways. Price also oscillates around the MA. This tells me that it's sideways market. That means I can both go long and short. Second, I look for support areas. I see that this low is equal with this low. So it seems that support down here. And third, I look for oversold stochastic with divergence. We got oversold here and divergence because price makes a lower low compared to this low and stochastic makes a higher low compared to this. And fourth, I look for the crossover, the stochastic crossing up through the trigger line, which happens here. This ends today's video. I hope you've enjoyed it.